Today, we're diving into a topic that's absolutely critical for real estate investors, especially those looking to invest passively in syndications: how to vet and underwrite a syndication deal. Kathy Fettke is out on vacation, so I'm Leah Collich, and this is the RealWealth Show.
You're listening to the RealWealth Show with Kathy Fettke, the real estate investor's resource.
Joining me today is Paul DiVincenzo, RealWealth Developments Syndication Manager. He's here to walk us through how our team underwrites syndication deals, evaluates assumptions, and stays conservative even when deals are competitive. Whether you're new to syndications or looking to sharpen your vetting process, this episode will give you a solid foundation to make smarter, more confident investing decisions. If you like this episode, make sure to visit realwealth.com, where you can view all of our current and past syndication projects. Let's bring Paul on. Okay, Paul, so let's start off by telling the audience a little bit about your role here at RealWealth. Tell us what you do.
Yeah, so I've been in real estate for over 15 years, and I joined RealWealth about a year and a half ago as the syndication manager. So as a syndication manager, my role is to find and vet the new projects, handle the underwriting for the deal, help raise the capital for the deal. Once the capital is raised, then as co-sponsor of the deal, we come in and perform all the assets to manage the deal to completion. Our team also performs all the asset management duties that are required over the course of the deal. So to summarize, we basically take the project from finding it from start all the way to finish to completion.
Yeah, you make it real easy for investors to be totally hands-off. So for those who are maybe new to the term syndication, if they aren't really familiar with that, can you quickly explain what that means to be invested in a syndication?
Yeah, so syndication is truly passive real estate investing. So what happens in a syndication is a group of investors pull their funds together and they place their capital into a professionally managed real estate project. So RealWealth Development is a co-sponsor on all our real estate deals. So the job of the co-sponsor is to manage the project and to mitigate risk for investors. So as I mentioned, RealWealth will do everything from structuring the deal, securing financing, managing the construction, managing the property managers. So the investors' basically role is to wait for their quarterly updates that we provide and then potential future distributions.
You guys have been really busy the last month. You've had a long-term syndication deal wrap up and return all the investor capital, and you just fully funded a syndication deal. Give us some highlights. What has been going on with RealWealth Developments most recently?
Bunch of highlights. One, our most recent project we just raised was our project in San Antonio. Wild Pine, it was a 56 unit built to rent. We raised the $3.6 million in equity and we have started the pre-construction on it. It is ahead of schedule already. And our loan terms actually came in better than our anticipated in underwriting. So we're off to a great start. One of the projects we just closed was a project in Dublin, California. It just ended last month. We sold the office building, and the investors received their 9.5% preferred return, which hit target returns that we predicted in the pro forma. So those are two great highlights. Really excited about the progress that has been going on this year in 2025.
Yeah, I'm really curious to pick your brain and jump into some of your thought process on like deal selection. I know, on my side of the business at RealWealth, I deal a lot with investors who are wanting to actually own the asset themselves and, control all the variables that they can control when it comes to owning a property. Who, in your mind, is an ideal person to invest with RealWealth Developments in a syndication project?
I have this conversation a lot with a lot of our investors. It's an investor that is looking to take their portfolio to sort of the next level or next step up. I hear a lot of investors that start in single family rentals. They're more hands-on. That's how they get going. It's easier to get into that single family rental just because of the amount of down payment you need to do the project is normally less. The big thing is they're sort of heading in the direction where they want to retire and not be involved in any aspect of the deal. So they're looking for something that's truly passive real estate investing, where you're hiring the sponsor, RealWealth Developments, to basically handle everything in the deal for you and to sort of look how you could mitigate risk into that deal. So I look at it as like a stepping stone. A lot of people start in single family rental, and then syndication allows them to diverse their portfolio into larger projects that might be a little more riskier, but on the back end, normally have higher returns to investors.
That's great. So, I think one of the barriers to entry when it comes to syndication investing is that there's far more variation in types of projects. A lot of people are familiar with, apartment flipping syndication projects or funds, but, land development is another one that we've done quite often. How much should an investor know about all of these different types of investing strategies before selecting a specific syndication project? Is that important?
Yeah, I mean, one of the first things that we do when I talk to new investors is similar to what we do on the single family rental side. We come up with a strategy or what are your goals? What asset class do you like? Not every asset class like land development is a little more riskier. That might not fit an investor's particular goals that they want. Maybe they want something a little more conservative, like a longer term built to rent project. So one, we find out, what is the investor goals? What's their, timeline? What kind of returns are they looking for? And then we could identify sort of what asset class. Because in syndications, there's no set template. Every deal we do is structured different. Every asset class, you have to structure the deal a little different based on obviously the location, the asset type, and then obviously what the exit strategy is. So you have to understand a knowledge of the deal and have some experience in investing, but then also understanding how to vet the deal is very important. Not just from the sponsor doing the vetting, but doing an investor's own vetting sort of behind the scenes before investing in the deal.
Yeah. And partnering with a reputable company that you trust. Paul, I think it's an obvious next question. I mean, speak to me a little bit about kind of your credentials, like when you're looking at deals all the time, like how do you know what's a good deal? Like what experience do you bring to kind of your analysis that kind of leads you in the direction of a project that you want to take on?
Yeah, so we have a sort of detailed vetting process. One, we look at hundreds of deals. Every week I try to hit 2 or 3 deals minimum that we're looking at. A lot of them don't pass the initial first few steps. But what we basically do is there's 5 components that we look at in a deal that we do sort of what I call a deep dive into that deal. One is obviously market growth, location. Do we see job growth in this market, population growth, infrastructure growth? Do we like the location, the asset class for that market? So that's sort of step one. Do you want to be in that market? Step 2 is looking at the potential co-sponsor. So we have the co-sponsor fill out a questionnaire that goes over their background and the market questionnaire for that project they're presenting in that particular market. So basically then we vet the sponsor. Is this a sponsor we want to work with? After that, we then go to our own internal market research. At this point, we bring in sort of a lot of AI platforms and we look at the data that the other potential sponsor sends us. We dig into it and we look at historical facts, like what are the driving factors in this market? Is what the other potential sponsor sending us accurate? And we do our own research and verify those findings. If we verify the findings and they look good, that's when we do the underwriting. So in the underwriting, RealWealth Developments has its own pro forma. So we take all those findings and facts that the other co-sponsor sent us, plus our data, and we put it into our pro forma. And that's when we basically run a sensitivity analysis where we start playing with the numbers, if increasing lease rates or cap rates, etc. So we would then go to a site visit and actually go to meet the sponsors and visit the site and determine if this is the right deal. So before we launch anything or before any of our investors hear about the next deal, we're hitting those 5 steps and doing a deep dive into all those steps at RealWealth. So if it gets through those 5 steps, that's when we say, okay, we got a go project.
Yeah. And just give us an idea, how many deals make it through to that point? Like, is there a percentage of how many you look at and how many make it through the gauntlet?
We've done like 1 deal in the last 6 months. So in the last 6 months, we are looking at 2 or 3 deals a week, and one of them has passed our vetting process that works out. So, it's a numbers game. You got to look at a bunch of them to make sure it's the right deal. That's sort of key.
Yeah, and I know sometimes it comes down to a little bit of a gut check. I know we had a recent experience. You had done a lot of the legwork of negotiations and gotten a deal almost to the finish line, but then you kind of had a gut check about a non-numerical factor in the deal. How do you keep a lookout for things like that?
It's sort of this making sure we're checking all our boxes and going through each step. Yeah, like we just had a deal. We were almost in the last steps of finalizing the deal. And, all the pro forma numbers look great. Everything look good. But, our job is to mitigate risk. And, there were some potential at the last minute, some potential other red flags that popped up. So besides doing the correct underwriting, you got to look at the location, the market data, who the other sponsor is, their background, who's going to be the construction company, who's the property management company. So, all those things got to come together to work out perfectly for us to basically say, hey, we want to move forward with the deal. So it's got to feel right in your gut that this is the right move. Not, again, the numbers could look good, but then you got to weigh in all the other, factors as well.
Yeah. Tell me, what is kind of number one on your list when you're looking for a specific type of deal? Are you prioritizing a certain geography over a certain return profile, or do you tend to be agnostic and just consider anything as long as the numbers pencil?
What we've done is going forward, we're setting sort of two key metrics, and that's on the return profile is looking at the IRR and the equity multiplier. Obviously, there's a lot of other returns you want to look at because of different asset class. We'll have different metrics. We found that, the IRR and equity multiplier could relate to a majority of the asset class. So we're trying to target that 16 IRR and 1.75 equity multiplier. So it's got to hit those returns for us automatically right off the bat for us to start continuing doing the next steps in the deal.
Yeah. And is there anything different about the current market cycle? Like stress testing a deal right now when we're in a little bit of a downward cycle in the market, I imagine that makes it a little more difficult to try to forecast the future. How are you looking at things differently in this context?
Yeah, it's been sort of very difficult underwriting, deals right now, especially with construction has increased over the years. Interest rates have gone up, lease rates have sort of stabilized and appreciation has stabilized in some markets. Basically, the main point that we're trying to focus on is doing conservative underwriting in these deals. So we do that sensitivity analysis, and by doing the sensitivity analysis, it gives us an idea of, hey, here's this historical data, here's how we should be underwriting it. And then we look at if the deal's better and if it's worse, what that looks like. And if there's too much risk in the deal, when you make it a little worse, we normally walk away from the deal at that point. So we're losing a lot of deals in the underwriting point right now, but that's okay. We want to make sure we're selecting the right deal moving forward. We continue to look at deal after deal until we're presenting the right deal to our investors.
Yeah, that makes sense. I think it's so prudent. And I know Kathy's been talking for a long time about all of the sloppy underwriting or maybe overly optimistic underwriting that was happening, soon after COVID. I'm imagining that maybe there's even more the potential for more distress, people approaching you needing a savior in a deal more so than like wanting to bring you in on a good deal. So I imagine now more than ever, you got to be pretty prudent with the things you're looking at.
Yeah, everyone's sort of in the same boat. It's tough underwriting deals at this point, especially after COVID. You saw increases in like rents of 6-7% year after year for a couple of years, and appreciation was great. So you can't just go in and put, because the last 2 years there was 6% increase in rents for that deal, you can't perform that year after year. You have to actually look at what's the market average, maybe pre-COVID, what was it? And that gives you the more accurate number. So, basically you can't just use the best and highest comps that you find in the market. You have to use, realistic numbers going forward, which unfortunately a lot of developers, might put in, the highest and best numbers to make the deal work.
Right.
That's our job, is then to say, here's the accurate numbers we should be using.
Yeah, that's good. So, okay, what are you excited about on the frontier for RealWealth Developments? Do you have any deals that are getting pretty close?
Yeah, we're working on a few exciting deals right now. One of them is actually a multifamily fund where we would have an open fund identifying key geographic locations and our key metrics of the 16 IRR and the 1.75x multiplier. So multifamily is an asset class that right now there's a lot of good deals popping up that are either like short sales or potential foreclosures that are coming up in the market. The issue that we're having is you got to move fast on the deals because you're getting them at a good price. A lot of people are moving after them. So having funds available at that time and us being able to move fast and not having to go raise the funds for a couple months will allow us to pick up some nice multifamily projects. We're also exploring potentially, self-storage is a great asset. It cash flows very well. It does good when the economy is sort of up and down. So that's another asset class that might be new to some of our investors, but has given out historically very strong cash returns and has done very well appreciation over the last couple of years. So we're looking at those asset classes. And then also, again, sort of focus on that AI. There's a ton of pre-manufactured homes that are very advanced now and not your typical manufactured homes that a lot of people think in mind. They're $500,000 to $1 million homes that help speed up the construction timeline and help reduce construction costs. So we're looking at a few projects that might bring in sort of AI, bringing in to help build some of these homes, pre-manufactured homes that could help save costs and time, which would result in higher returns for the investors. So a lot of new exciting stuff should be coming out very shortly here at RealWealth.
Yeah, it sounds like it. So if somebody is interested in kind of following what RealWealth Developments is doing and putting out, what's the best way for them to know about these new projects?
Yeah, on our website, you could log in and sign up. There's an option to click for syndication or group investments. If you sign up and you click for syndication and group investments, you'll get all our newsletter, our marketing emails that go out every week, along with when we launch a new project, you'll hear about that new project.
Great. Well, Paul, it was so good getting to learn more about your side of the business. I know you stay very busy looking for these good deals to bring to our network. So thanks so much for bringing that information to us here today.
Yeah, thanks for having me.
Thank you for joining me here on The Real Wealth Show. Like Paul said, visit realwealth.com to learn more about syndications or to learn about single-family rental investments. We'll see you next time.
Views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.